Welcome to the Understanding Interest and Financial Protection video. In this video, we will give you an overview of how interest rates affect the overall return on your savings. We will also look at the protection offered to savings held in banks and building societies in the UK. If you're looking to save for the future, bank and building society accounts can offer a way for you to save either lump sums or regular payments. The money that is held with a bank or building society will normally earn interest. All accounts will show the interest that is payable as a percentage, and this agreed rate of interest will be added to your savings. The amount of interest paid varies between accounts. Current accounts, which are normally used to pay bills and receive your salary, usually offer the lowest rates of interest. Fixed-term and regular savings accounts, which are specifically designed for savings, will usually offer higher interest rates. Different accounts may pay interest at different intervals too. For example, some accounts add interest to your savings each year. Other accounts may add interest into your account more often, for example at the end of each month. How often interest is added will affect your overall returns. This is because interest is earned on your original savings plus any interest already added to your account. This is referred to as compound interest. Let's have a look at an example of how this can work. Let's assume that some money is paid into an account and interest is added at the end of the first year. The interest payable at the end of the first year is calculated as a percentage of the original amount deposited. At the end of the second year, interest is added again. This time interest is calculated based on the original deposit plus the interest added at the end of the first year. In year 3, this is repeated again. This time interest is added based on the total value of the original deposit plus the interest added at the end of years 1 and 2. This continues into the future. The more times interest is added, the greater the total value of savings held in the account. Let's have a look at this same example but using numbers. Assume that £100 is deposited into a bank account and that this account pays 2% interest at the end of each year. At the end of year 1, £2 of interest is added to the original deposit of £100. At the end of year 2, 2% interest is added again. However, this time the interest is applied to the original deposit of £100 and the £2 of interest already added, which results in £2.04 in interest. The combined total interest now received into the account is £4.04. At the end of year 3, this is repeated again, with total interest paid into the account reaching £6.12. This now continues for as long as the money is left in the account. After 10 years, a total of £21.90 in interest would have been added to the account. Of course, interest rates may increase or decrease in the future. For the purpose of this example, we have assumed that interest rates remain unchanged. Higher interest rates, paying more into a savings account, and leaving the money in the account for longer will mean compounding interest will have a greater effect. As we have seen, compounding interest can make a difference to the overall returns you will receive. As different savings accounts pay interest at various intervals, this compounding effect can lead to a different total return when comparing accounts. Further to this, some accounts pay a bonus. This is a lump sum of interest that is added at the end of a fixed term and increases the overall return a saver can expect from an account. To help make a fair comparison between two bank accounts, all accounts show an annual equivalent rate, or AER. The AER takes into account the different timings of interest payments and any bonuses payable, producing an equivalent interest rate over 1 year. This AER is the best way to compare interest rates between two different accounts. If you would like to understand more about AERs, what they mean, and what to look out for, you should watch the short animation that is available on this site. As well as earning interest, holding your savings in a UK bank or building society is a good way of keeping your money safe. The risk of a bank or building society failing is small, but it could happen, particularly in a market crisis. As a result, the Financial Services Compensation Scheme exists to protect your savings held within any UK bank or building society. Should the bank or building society you hold your savings with fail, the Financial Services Compensation Scheme will protect your savings up to certain limits. The compensation limits provided by the Financial Services Compensation Scheme can change from time to time. To check the current limits, click the next steps below the video. You should be aware when reviewing these limits that the limits apply to all your savings with each authorised bank or building society. If you have large amounts of savings, it may be wise to split these savings up between different banks or building societies. Before doing this, you should check that the bank or building society you intend to use is not part of the same group. This is the end of the Understanding Interest and Financial Protection video. Please click the next steps below the video to learn more and use the Knowledge Checker to test your learning. Please be aware that this video is provided for illustrative purposes. It is not intended to be used for financial planning and does not constitute financial advice. Whilst every effort is made to ensure the accuracy of information contained in the video, it cannot be guaranteed.